Hi everyone, welcome to this market update. Well, we're halfway through the first half reporting season here domestically, and we thought it'd be worthwhile just touching base on how I've seen performance of companies so far in this reporting season and how I've been positioning that across our portfolios. Firstly, we really do feel that company reporting to date has actually been quite solid. And we've been fortunate enough to have a number of the key companies across our portfolios deliver what we believe to be very solid results. It certainly underpins our thesis as to why we've been holding those positions, and certainly equally underpins our thesis that we believe the outlook for growth assets, particularly equities, over the medium term still remains quite robust. Just a couple of those results. If we think about a company such as James Hardie, a fantastic result in terms of its global operations across all of its business lines. The company continues to evolve its offering, and as I said, is the main player in terms of fiberboard cement sheeting in the US and has a dominant market share. And we certainly believe, as I said, its results reflected the strength of the business as well as the opportunity that we see going forward as well. BHP, again, had a record result in terms of free cash flow on the back of stronger commodity prices, particularly iron ore and copper, and that led to the company's record dividend payout. So again, we're starting to see that really start to come through on that basis, and Rio Fortescue particularly as well also had some strong results on the back of, as I said, both production and high commodity prices. And then we had some businesses that were certainly through the eye of the storm through 2020. If you look at companies such as Brambles that operates in the pallet business, fast-moving consumer goods, not only here domestically but equally in Europe and the US, really suffered quite significantly in terms of the economic slowdown and lockdowns that we saw over that period. But the business, from our perspective, actually delivered a very solid result. But more importantly, is positioning for the growth, both in terms of the opportunities that it's looking at in regards to its pallet business through cost control and just creating greater efficiencies, as well as I said, managing increased sales in other jurisdictions around the world. So we certainly feel that a business such as Brambles, as I said, despite the challenges, delivered a very solid result, and that's been reflected in its share price more recently. And then Transurban as well, as we know, toll roads, both domestically and globally, volumes have been hit significantly, as we know, just on the back of the lockdowns. But again, from the perspective of the overall quality of the asset mix, the ability of the company to be able to, as I said, manage that as best they can, control costs where they can, and then continue to look for pipeline of growth opportunities. We think that once the economy starts to reopen, once people start to, as I said, be able to move around more freely, we think that Transurban is really well positioned for growth on that basis. And then on the tech side, we saw a company such as Tyro, which is in the payments model, so just on the FPOS payments system, again deliver a very solid result on the back of certainly what has been a challenging period, particularly for hospitality, cafe, tourism, as well as healthcare on that basis. And as I said, we certainly believe that the company is really well positioned for future growth, introducing new and different means by which it can, as I said, advance its payment model, has been able to increase its margins, which was certainly something that we were impressed with when we heard from company management. So all in all, we certainly feel that there's been some very solid results, and I think one of the elements associated with it, we saw very few companies come out before reporting season and, as I said, do significant downgrades in regards to their outlook. And we think that that's been really positive, as I said, and well received by the market. The ASX 200 is up roughly around about 3% over the month to date. Certainly we've seen equally some significant rises in offshore markets, particularly around emerging markets and global small caps. But in our view, as I said, the outlook for growth on the back of the rolling out of the Pfizer vaccines for COVID, we think is actually going to be really positive for equities over the medium term. And we also saw an operating update from the banks. The major banks provided an overview of how their trading conditions are at, and by and large, again, we certainly thought that was relatively positive, and on a couple of fronts. First and foremost, their loan deferrals programs were starting to roll off a lot quicker than certainly we anticipated originally, and certainly I think equally the way the banks were anticipating on that front. So we certainly saw bad and doubtful debt provisioning decline over the last 3 months through the back end of last year, and we think that's a positive in terms of capital adequacy and in terms of, as I said, ensuring they potentially won't have any, as I said, negative impacts on those provisionings going forward. Secondly, the banks were able to increase their payout ratios again without dropping its cap on dividend payments. And again, we think that's absolutely a positive for the banks over the medium term and their ability, as I said, to re-engage with their investor base, particularly those that are wanting increased income and yield. And then thirdly, their net interest margin. So really the operating margin that the banks claim in terms of their underlying businesses. We've started to see a stabilisation of those net interest margins over the most recent periods. And again, we think that we may be at the bottom cycle in regards to those margins falling. And as we move on from here, as the growth outlook starts to improve, lending environment starts to improve for banks, and they may be able to continue to grow those margins, which again, we think is a positive. And as it relates to Macquarie, which is our most significant bank position across our portfolios, again, slightly different to your broader retail banks. But as I said, from its asset quality in terms of the diversity of the business, a number of upgrades have come through on the back of that since it provided its results to the market a couple of weeks ago. So, we're really relatively comfortable with our position in the banks. We've been reducing our underweight exposure, so we've been adding particularly to NAB and CBA, who we think are best positioned in terms of the retail bank offerings, whilst maintaining our current overweight position to Macquarie. We're still underweight. We still think there are some challenges over the short to medium term as it relates to the banks. We've got obviously Drop a Keeper program potentially dropping off at the end of March. So I think some of those elements associated with the mortgage market, deferrals, as well as non-provisioning, provisioning of doubtful debts, we think is still, as I said, could create a little bit of a headache. But notwithstanding that, generally quite positive. And then finally, just to finish off on bond yields, as we've spoken about previously, we've certainly been underweight fixed income across our portfolios, our multi-asset portfolios, and we've seen quite a significant uptick in bond yields over the most recent period, particularly at the long end of the curve. So that actually creates a negative return for investors over the journey. And as I said, we're expecting, as the economic recovery comes into place, that we would see bond yields start to move higher. And as I said, that has certainly occurred over the last 3 to 4 month period. Domestically, our 10-year bond yield was roughly around about sort of 78 basis points through the back end of last year, and it's now ticked over 1.5% for the first time, as I said, for a number of years. So we have started to see that sell off, and consequently we have been, as I said, reducing our exposure to bonds within our portfolios for a period now. And as I said, we'll continue to look at that. But certainly in our view, as the economic recovery starts to pick up pace, we think that'll be a challenge for that defensive part of client portfolios. And as I said, the way that we've been managing that from an asset allocation point of view, as I said, has been to reduce that exposure in favour of growth assets, equities, or alternative growth assets within our portfolios, to balance out some of that risk. So it's an interesting time at the moment. As I said, we certainly feel that markets are really looking forward as it relates to that growth outcome. Our local markets up nearly 3% month to date. We've seen global markets up over 4% over the month, led by emerging markets and global small caps. And as I've said earlier, as that recovery starts to come through, as more and more people are inoculated, as economies start to reopen, as we start to re-engage in terms of the jobs market, and people can, as I said, move back into industries that have been impacted by COVID and by the lockdown, we think that that's only going to be positive for the growth outlook, and that's going to be positive for growth assets by and large throughout, certainly throughout the first half of this year. And as I said, we'd be looking, as I said, over the medium term that'll be the case. One caveat is to watch out for, which is what we'll be doing, is clearly what we're seeing in fixed income and bond markets. As I said, that can have an impact not only in terms of those markets, but that can also flow on into equity markets as it relates to the pricing of cash flows for individual corporates. So a lot to think about, but we continue to remain very constructive on the growth outlook over the medium term. The beginning of the rollout program here locally, we think is a great thing, as I said, for the domestic outlook. And as I said, we think that that'll be really positive for growth over the medium term. We'll touch base at the end of this reporting season. We've got a live webinar going on as well on the back of that, if you don't get a chance to hear any more of these updates. But as I said, we'll look forward to touching base again soon. But if you've got any concerns, please feel free to reach out to anyone at the team at Carrington's. Thanks, and bye for now.